Well, you don't often see bank analysts come out so strongly and say they think conditions are in place for a bear market, which is a fall of 20% in the US share market. To stop the bear, they said today, Trump needs to pull back from trade wars and focus on tax cuts, deregulation and infrastructure, i.e. the things companies like. The key reason for Macquarie's gloom is a decline in US consumer spending, which they say is the most consistent driver of bear markets. And what everyone's talking about in America is this: the price of eggs. Donald Trump promised to get it down, but he hasn't succeeded so far because it's largely the result of avian flu, which even he can't stop. And as a result, investor sentiment has turned negative for the first time since 2023. It's not yet into fear territory, but it's closer to fear than FOMO, or fear of missing out. Of course, Macquarie's bearish note coincided with a big 2% gain in the US market on Friday, and markets in Asia today went up more than 1%. So it's always the way, isn't it? The Australian market had its second solid rise in a row, with especially strong gains by the iron ore miners, probably because the Chinese government announced plans to vigorously boost consumption and expand domestic demand in all directions. Now, in case you're wondering whether the Australian share market has done better or worse than America's this year, they're exactly the same, down about 4% year to date. The Australian dollar is also stronger tonight, back above 63 US cents, and commodity prices haven't yet seen the impact of today's news from China, so iron ore, copper and gold didn't move over the weekend. And that's finance.